Good morning, everybody. We appreciate you all being here. Very pleased to introduce our speaker this morning. Our speaker is Chris Green. He has an agency in Covington, Georgia, which is just outside of Atlanta. I'll tell you, Chris is the flood insurance guru. Okay, and we're really excited to have him here. If you've not checked out his website, floodinsuranceguru.com, check it out. It is an amazing vault of content, so be sure to check that out. Chris is one of the foremost experts on flood insurance in the country. He has an undergraduate degree in actually like disaster management, and he was finishing up his studies at the same time that Hurricane Katrina hit. So he spent a lot of time learning about flood insurance and disasters, and then eventually kind of transitioned that into what he's doing now. Chris is going to speak about flood insurance today, but I promise you, pay attention to what he has to say. He could be here. He could be up here talking about employee culture. He could be up here talking about automation, about marketing and content development. He does an outstanding job in all of those areas. But today, we're going to have him talk about flood insurance. So without any further ado, I'll introduce the 512 fullback from Jersey, Georgia, Mr. Chris Green. Thank you.
Thank you, Albie. Can everybody hear me okay? Okay, just making sure, because it's the first time I've used a wireless mic like that. So my name is, as I said, Albie said, Chris Green. I run the Flood Insurance Guru. Today we're going to be doing a 3-hour CE on changing flood markets for North Carolina. I'm going to give you a brief background on myself. I'm going to try not to spend too much time on that. Don't want to bore you. And then we're going to go into, the first part we're going to be talking about NFIP, Risk Rating 2.0. I'm sure y'all have a lot of questions on that stuff. So that's going to be kind of really the first hour we're going to talk about. If you've got questions throughout though, please raise your hand. I'm here to answer those questions. I always hate getting to the end and you had a question, you forgot what the question was, and it didn't really help you much. Make sure this works. There we go. I'll tell you how we're a little bit different. Like Albie said, I actually have a master's degree in flood mitigation. And I'll tell you, actually it wasn't supposed to be flood mitigation. Hurricane Katrina hit the first day I started my master's degree. I was actually supposed to do bioterrorism and hostage negotiation. Well, I ended up studying Hurricane Katrina for 2 years, studied every flood, from Katrina all the way up the entire Mississippi to Des Moines. We are an education-first company. You know, what this means is really that we've got more than 15 years experience in this industry, not just on the insurance, but on disaster assistance, on disaster grants, a lot of these different things right now. We specialize in this from Puerto Rico to Hawaii. So that's kind of how we're a little bit different. If you said, like, if you visit our website, we have a learning center that's got about more than 5,000 pieces of content that we've all created over the last 4 years. So that's just a little bit how we're a little different. I'll tell you my story a little bit. As I said, I've told you a little bit how I bought a house and how I got my master's degree. But really how I got into this is about 10 years ago, I went to buy a house in a flood zone. And the real estate agent didn't know what they were doing. The lender didn't know what they were doing. Even the insurance agency I worked for at the time didn't know what they were doing. We got 2 weeks before closing. They're like, hey, your premiums are going to be about $3,000. The deal's not going to work out. Your DTI, which is your debt to income, is too high. And so I started doing some research, found out the house should have been grandfathered because it was built in compliance. Took a $3,000 rate, turned it into a $300 rate, and we've been helping property owners do this exact same thing for the last 10 years. So that's kind of brief. I said briefly my story. I started creating flood content January 1st, 2019. We've done a different daily flood education video every day since then, blogging, podcasting, really whatever the flood issues that are going on across the country. Right now we're spending a lot of time helping people in St. Louis get disaster grants and assistance, monitoring presidential disaster declarations to see if they qualify, which goes way beyond the insurance side. So when it comes to flood insurance, buying flood insurance can be complicated, confusing, and frustrating. At least that's what I experienced. It seems that that's what a lot of people experience. So really when we started looking at doing not just the CE classes, but helping people with our website, we were like, there's got to be a better way. It shouldn't be this difficult to purchase a insurance product. So as I mentioned, some of the objectives today that we want to talk about are going to be the Risk Rating 2.0. We're going to be talking about private flood insurance in North Carolina because North Carolina is such a unique state when it comes to flood risks. We're going to be talking about understanding these flood risks, and we're going to be talking about some local impacts. My goal here today with the local impacts is, I don't really want to discuss much outside the state of North Carolina, because being in North Carolina, what good does learning something in New York help you? It doesn't. So we really want to talk about the local areas, maybe some of the struggles that you are having right now in the market. Maybe you're not sure, what to do in this situation. The goal today is to help you, give you a better understanding of that. So when it comes to flooding and flood risks, when it rains, it can flood. That's a big challenge we've been having lately. Just yesterday, I spoke to a customer who was purchasing a home, and she says, hey, I don't need more than $250,000 in coverage because I'm not on the coast. So for some reason, people get this idea in their mind that it only floods on the coast. And what we've discovered is actually the bigger flood threats aren't necessarily on the coast. They're in areas like Nashville, Tennessee. They're in areas like Charlotte, Raleigh. These areas that are getting excessive amounts of rainfall. I grew up in Birmingham, Alabama, and actually 1 year ago, next month, we had 13 inches of rain in 6 hours. We had 82 home rescues in 2 hours. Interstates actually turned into rivers. It was something people had never seen. We had 9 feet of water in most of the properties. We had customers who had just bought their house the day before, hadn't even moved in yet, and had 8 feet of water in their house. So when it comes to flooding and flood risk, that's something really important to educate your clients on. It's, where's the flooding, where can it happen? And that's why North Carolina is so challenging. You've got mountains, you've got beach, you've got flat areas. So there's a lot of different flood challenges in the state of North Carolina. Some flood insurance states and facts you can take a look at. I'm not going to go too much through here, but one fact that's probably not up here that I will tell you is that the majority of flooding and flood claims, about 30%, actually come out of areas where flood insurance is not required. When it comes to filing claims, disaster assistance, it's people who generally didn't have it because it wasn't required. But when you think about your house burning down and you think about it flooding, the chances of your house actually flooding are actually higher than it being burned down. Here are some more facts for you as well. If you want to take a look at those, I said I'm not going to go too much into those. But as I said, we talked briefly, one of the things up there is about the percent of flooding that comes out of non-required versus required. We'll talk a little bit about some of those flood zones later on in this presentation. All right, so now we're going to get a little bit into some of the changes that we're talking about with Risk Rating 2.0, and I'm going to call it legacy. Whenever I mention the word legacy today, what I'm talking about is the traditional NFIP program. So part of the big changes of NFI changes was with 2.0 was that people were like, oh, my rate's going down. That's awesome. Or, oh no, my rate's going up. And so that's one of the challenges we're seeing is that, like FEMA has briefly talked about in some of these areas, that premiums were going, $10 to $100 more per month in some areas. They were going down $10 to $100 per month in some of these areas. The conditions where private flood insurance should be accepted on loan types. That was a struggle back in 2019, and in 2019, FDIC actually worked with HUD and some other people to accept private flood insurance. So private flood insurance started to be accepted back in 2019 on most loan types, roughly except for FHA, because FHA does not issue loans, they insure them. However, hopefully this month, FHA will be making a public announcement about accepting private flood insurance. They talked about this back in 2020, and then COVID hit, and we've still been waiting for an approval. And so we're hoping to have an approval within the next week or so as they meet with a final bulletin with Congress. So as I mentioned, in the legacy program, which we're going to talk a little bit about now, traditionally flood zones had a big impact on flood insurance rates. Especially flood zone X, you had what's called your preferred rate. May have been what, $400, $500 a year. You had coverage amounts up to $250,000 on residential, $500,000 on commercial. And then of course you had your contents at $100,000, business inventory up to $500,000. So those were some of the things with NFIP legacy is that, the flood zone was a big rate driver. And today we're going to talk about what the new rate drivers are. We're going to talk about personally some of the experiences we're seeing every day in issuing insurance, some of the struggles customers are seeing, some of the surprises agents are seeing that they just weren't aware of when it comes to this new 2.0 program. So Risk Rating 2.0, really, what is it? They call it equality in action. So what it was traditionally is that, hey, We want to balance things out. We felt sometimes that other people were paying higher flood insurance premiums for other properties. They call it, creating maybe a fair playing ground when it comes to this new program, is because risk was going to be looked at differently than a lot of subsidized rates. Flood zones, let's say my house is in a flood zone AE, your house is in a flood zone AE, but should we necessarily have the same rate, just simply based on the flood zone? Those are some of the things they wanted to address with 2.0. 2.0 got pushed back, and then finally went into place in April of 2021 for new business, and then the following October it went in for renewal, and we'll talk a little bit about that today. So skip that. So as I said, some of the brief things, you can take a look at this slide here with NFIP versus NFIP 2.0. There's a lot of similarities. There's also a lot of differences. As you take a look at this, something we'll talk about later, something I created called the fingerprint of flood insurance. And really what it does is talks about the really 5 main factors of driving a flood insurance rate now. But if you want to screenshot that or take a picture for later on, we can also email this presentation out if they want us to do that as well. So with risk rating 2.0, one of the big things we're seeing is, of course, elevation certificates are no longer required. But what we're seeing in the marketplace with agencies is they're still telling customers they're required when it comes to these elevation certificates. The other thing is that flood maps are really only used from a regulatory standpoint now. And later on, we're going to look at some flood maps to kind of look at the different colors and show you where they're required, they're not, what they really mean. And so that's one of the big things with flood maps now. So these flood zones no longer determine flood insurance rates. Actually, the flood zone has no impact whatsoever on the flood zone. There's also something called claims variable we'll get into. It's kind of really something you want to understand when you're talking with your clients about potentially filing a claim, helping them understand long-term, short-term impacts. What could a $500 claim have on a policy? Phase 1, as I mentioned, was actually October 1st, 2021. This was for new business. So any policy that was written after them, which I'm sure y'all have already noticed, raise your hands if you've written a flood policy in 2.0 yet. How was the experience?
It seems like the rates has really went down a lot.
How was the quoting process for you?
It was good.
Good.
It was pretty easy and everything. I know it seemed like he was paying, I'm thinking he was paying $9,000. And $9,000, and it was going to go up to, seemed like 12, and I got it down to like 3.
Mm-hmm. Was it a coastal property?
No, it was just a house beside a creek,
Yep.
river.
So later on, we're going to talk about some of the, what you're talking about right now, like the increase, the decrease, based on the old flood zones. Really, what we're seeing in the market. That's what I was curious. Phase 2 was April 1st, 2022. Really just happened not that long ago. What happened is these policies came up for renewal. Let's say your policy renewed March 1st, 2022. You didn't have to go into risk rating 2.0 yet, but you will on the following renewal. But what happens is you can actually change it at any time. Like you mentioned, if you see a rate decrease, one of the cancellation reasons now is going over the 2.0.
And I've seen that on one too.
So that can be beneficial. So it's just something, as we're talking about this, you really want to think about and pay attention to, is that it could benefit them right away. Because regardless, when it comes up for the next renewal, they got to move anyway. So if you're going to be able to save them, and I'll give you an example. We had one that we were really struggling on. It was a lake property. The premiums had been $3,500, $4,500 a year. And when 2.0 hit, it was $1,150 a year because of how the risk was being looked at. So then one thing you'll hear me say is that risk rating 2.0 is not necessarily a bad thing, but yes, there are some struggles with it. It's not perfect yet, but it is benefiting some people across North Carolina as well as across other states. This is what I talked about with the fingerprint of flood insurance. Usually you'll see me in this image, but it's not in here because it's CE. If you want to take a picture of this a little bit, these are really the factors that drive a rate now with risk rating 2.0. As I mentioned before, it used to be flood zone X, AE, maybe an elevation certificate. With elevation now, you've got distance to your lowest grade. So a crawl space is no longer considered the lowest grade with FEMA now. It's the next level up, which is very great for the customer and using that lowest rated floor. Distance to water, this is a big struggle we're seeing right now. So if you have a dried up creek in your backyard, your rate very well could skyrocket because FEMA considers that to be a water source. There may not be any water in it for 20 years, but they're looking at distance to water. That's a big thing. Maybe if you have a pond behind a business, they don't think about that water source. That could be a big driving rate factor. Flood frequency. This is a big thing that's used now is you've got a lot of these areas that experience flash flooding a lot throughout the year. Let's just use Houston, Texas, for example. Not even looking at hurricanes. Houston has a big problem like New Orleans does. So they have a lot of excessive rainfall floods throughout the year. Nashville, Tennessee's had several the last few years. St. Louis. And so those things are driving the rate as well. Type of flooding. If you're in Wilmington and you have coastal flooding, or if you're in Winston-Salem and you have flash flooding, those are two different types of flooding sources that they're looking at and determining that rate. And then replacement costs. Really, can be something that's very dangerous on the commercial side. So on replacement costs, you don't have to use it necessarily to set up a policy. FEMA's putting it in there, but replacement cost has a big impact on the rate. So let's just say that you have a $250,000 policy and the replacement on the home is $450 compared to a house with $250. Rate could be 40% higher, even though you're not taking out any more coverage. So you really want to pay attention to this. And where we're seeing a big impact on replacement cost is actually on the commercial side. So a lot of times with FEMA now, write your own carriers, they don't have the data to do the replacement cost. So let's just say someone comes to you, you're writing a policy for $500,000, and of course you do the coverage for $500K, but the replacement cost is really $2 million because they're going to ask for a replacement cost estimator. That rate can skyrocket. We just actually had that happen this week with an agent that was setting up a policy for a business owner, and they got this rate of $1,000, and they reached out to us, and we were looking at it. We said, here's the problem here. In 3 weeks, when FEMA reaches out to you and says, hey, I need a replacement cost estimator, the rate's really going to be $2,200, which could create a really bad experience for the customer on the back end. When they come to you and say, why is my rate going up $1,200? It's that replacement cost estimator. So if you're doing the building on its own, not flood, just use that replacement cost estimator. There's a company called Massive Cert. That's MASSIVECERT.com. If you want to get one from them, I think they charge a couple bucks to do it. We use them a lot if we just need a replacement cost estimator on the commercial side. So that's really something you want to pay attention to when you're writing these policies, is that replacement cost can really come back and bite you if you're not careful. So let's talk a little bit about these elevation certificates. You heard me mention before, they're no longer required. That doesn't mean they don't help. One of the big things with elevation certificates is, does anybody remember how many diagram numbers used to be on an elevation certificate? It was around, I think, 10 or 11. They could be really confusing. It's like you had 2 different types of slab. You had 4 different types of crawl space. Well, they've tried to simplify this really into these 6 areas now, where you don't necessarily have that below grade crawl space and above grade. You just have a crawl space. You've got your elevated with enclosure. Now, elevated with enclosure has been kind of misleading for a few years, especially if you work with a lot of real estate agents. They'll send you a lead, hey, this house has a basement. But FEMA doesn't consider it a basement. FEMA really considers it an elevated with enclosure because it's a walkout basement. So that's kind of one of the things that they've tried to eliminate that confusion as well there too, is having that elevated with enclosure, elevated with no enclosure, especially if you're on the coast, and piers and pilings. And so these big things, let's just talk about the crawl space. If you've got the vents in there, not even if you don't have the vents, as long as there's no living space, so the crawl space now, the next floor up is going to be considered your lowest grade floor. That means that's the level FEMA's using in their data to determine it. Now with these elevation certificate diagrams though, so there's only really 6 diagrams now, so they're really trying to simplify it. Still a little confusing, but it's getting a lot better than it was. So in regards to diagram numbers on elevation certificates, those are some of the changes you're going to see. You're probably going to start seeing those soon with surveyors, because surveyors are getting caught up on these new regulations, but we still have not seen them come in on the elevation certificates with the new diagrams yet. But what's really important to understand is that, hey, say you have a surveyor go and do one of these elevation certificates. They're actually not held responsible for the diagram number. The only thing a surveyor is held responsible for is the actual survey numbers. So it's not uncommon for us to have to call FEMA to get them to correct the diagram number, as long as it's not the elevation numbers that are wrong. Now, I've seen surveyors where they will accidentally shoot the wrong numbers and put them on those. That part they can be held responsible for. But usually when you reach out to them, they'll see the error and they'll want to fix it simply from an E&O standpoint. As I said, we talked a little bit more about elevation certificates. When they're required, they're not. Risk rating 2.0 still uses elevation certificates. You have two options here. You can use the elevation certificate or you can use FEMA's data. Now, what we've seen so far is that FEMA's data is off still 30-40% compared to an elevation certificate. And one reason is that they're shooting all these different things. They're using all these technology things, Google Earth, Google Maps. But at the end of the day, a human putting their hands on that risk is still going to be the most accurate. So replacement costs, I said, we've talked about a little bit about this on premiums. I'm trying to go back on these elevation certificates. Let's see if it'll let me go back. There we go. So in elevation certificates, one other thing I want to show you too is, let's say that you go and help someone who doesn't have an elevation certificate. They decide to get one 4 months down the road, and you decide to submit it to the National Flood Insurance Program. It can actually benefit them, and FEMA will actually go back to the effective date, put the elevation certificate on there, and actually prorate the policy. So in case someone's wanting to get that, what I was telling them, there's really no way to know if it's going to be beneficial until it's actually done, unfortunately. I mean, sometimes it can be a big waste of money, but it's important to know that, hey, the policy can actually be prorated based on the elevation certificate when it comes to having these in a system. So just because they're not required, don't think they're not going to be beneficial anymore, they're not going to help anymore. Another area is, does anyone know where to find an elevation certificate if one's been done? So usually you can go to the county. Now I will use Florida as an example. I wish every state did it like Florida did. Florida actually requires elevation certificates to be on file for every county except for 2 counties in the entire state, which can be beneficial. So if it was like a new construction a few years ago, the zoning department might have it. Other than that, the current property owner might have it, or the surveyor who did it, if you can track that down. Those are really going to be the ways to get it. But the great news is when it comes to elevation certificates, you're no longer getting that message of, hey, we can't give you a quote because of an elevation certificate. So replacement costs and premium rates, we've already talked about that a little bit, how big of a factor this can be, but what does FEMA accept for that replacement cost estimator? There's a lot of things. You can go to, as I said, one of your traditional carriers and use their replacement cost estimator. You can use appraisals and things like that. Now, what happens if you don't get these in within their deadline? Now, the good news is the deadline's moved to 30 days. When they first went to 2.0, it's 10 days. And customers were actually getting cancellation letters after 10 days if it had not been uploaded. But if they submit it to you and you don't get the information, yeah, they're going to send out a cancellation letter on that policy. And let me tell you how long it has taken, what we've seen so far when it comes to refunds in that situation. We just got a refund check on one that we did in December last week, which was, 9 months? They get a refund back. As they were switching over to this program, there's been a lot of delays. And so it can be challenging getting their money back too if the information is not put in there accurately. Now, thankfully, as I said, they give you 30 days now, not 10 days, what they originally had when this program came out. We're going to talk about a few things, briefly, what you want to know about 2.0. I try not to overwhelm you with data, but just really some 10 things that you could use when using your customers, working with real estate agents, mortgage lenders, and things like that. And the first thing is effective dates. As I said, we've already talked about those. Something that's not changing is wait periods. You still have your standard 30-day wait period. You still have your 1-day wait period on newly mapped, and you still have the no wait period when it comes to loan types, if it's for a loan closing. Now, it's important to understand this on the loan closing part, that remember, it's not necessarily for real estate transactions. It's for actual loan closing. And so we have a lot of people say, well, I'm closing on this house, but they're paying cash. There's still a 30-day wait period with the National Flood Insurance Program on that because there's not a loan involved. So you just want to be cautious with that. Coverage is not changing as of yet. The ultimate goal when 2.0 came out is they wanted to change the coverage. Because let's be honest, let's think about the replacement cost of these properties. Just think about what these properties are selling for. $250,000 is not going to go very far. But they really wanted to push this out, to get it out. One of the big things they're focusing though is increasing residential coverage because it's just so low. Policy assumptions is still something with 2.0. Has anybody ever done a policy assumption in here before? Or does anybody know what it is? So a policy assumption is really something as an agent you really want to know what it is. What this is when you move a policy from one homeowner to the next. Yeah. So as I said, a lot of people like to call them policy transfers, but technically FEMA calls a policy transfer when you're going from like one write your own carrier to another one. Policy assumptions were very beneficial in the legacy program. In fact, I did one on my own property. That's how I kept it at a $350 rate. But in 2.0, some of the benefits of the policy assumption, though, is if you go in and set up a new policy, they're going to give you what's called the full risk now on 2.0. That policy assumption is going to have those statutory rates that are going to increase each year, a max of 18%. And I'll give you an idea here. We had a customer come to us that we did a quote for, $3,000. The current policy was $400. Well, it could take them 15 years to get to $3,000. So that's where the policy assumption can be beneficial. The other thing is too now with the new program is that you can still give them the continuous coverage credit if you've got a copy of that policy and that policy number. Maybe the customer doesn't want to do a policy assumption. You'd be surprised at the amount of people that when they've paid that, they want that money back and they're not really interested in doing the policy assumption. But you can still go in there and put whoever the carrier is, put the policy number, and you're going to see a big difference in the rate because of that continuous coverage. So that's policy assumptions. If you want to know more about policy assumptions, if you want to reach out to me, I've got plenty of videos that kind of walk you through actually how to do them. It's pretty simple. Usually, you've got to get a buyer to sign off, you got to get the seller to sign off, and you got to get the mortgage information. And roughly, it takes whoever you're using, you write your own carrier, about I tell people 5 to 10 business days to be on the conservative side. You can usually get it done faster if you have a good relationship with your write your own carrier. Personally, the one we use can usually get it done for us in 2 or 3 days just because we've done it so much that going through that process, we kind of know how to accelerate it. Some of the other things, let me give elevation certificates we've already talked about. Flood zones, flood zone X, flood zone A, flood zone AE, even VE on the coast now. No impact on rates whatsoever in the new system. Which is really a good thing. I've always been a big believer that flood zones should not determine rates because basically what you're saying is everybody in the same rate with the same type of house is going to have the same rate when it comes to these zones. The other thing is I feel that zones also mislead people to think that they don't need flood insurance because it's not required. So one big thing that FEMA is also focusing on with 2.0 is helping people understand what is the real risk. There's a lot of companies out there like I think it's Flood Factor. They give people a lot of different ones. If you go to realtor.com, they even have it on their site of what a risk score. We even do that on a risk tool we built for our website. From 1 to 100, it tells the customer, hey, what's the likelihood of my property flooding? How close to water am I? What flood zone am I in? Is it required? And what's the estimated premium? Because you want to make sure they understand that true risk. Because a lot of times they're just so used to looking at flood zone X or AE, is it required or not? Half the time is all they care about. Rebuilding costs. We've talked a lot about that with the 10 things to know, is that plays an important role. Property elevation and the lowest habitational floor. We're talking about here is like crawl spaces and really even basements now. That even though you're rating it with a basement, the lowest rated floor, it's going to be the next floor up in a lot of these situations. Types of flooding and flooding frequency, you're going to start to see a lot of this in areas that aren't on the coast. You're going to start to see a lot of these rate increases with 2.0. Flood zone X, traditionally $400 to $500 a year. What we're seeing as an average across the country now is $1,200 to $1,500 a year. So that's pushing a lot of business to the private side. And we'll talk about that a little bit later today on the private side about how these things are having impact. Distance to water. As I said, these are a lot of water sources people don't think about, dried up creeks. You build a pond in your backyard, your flood insurance could skyrocket because of how the distance to water, because FEMA's really actually updating this every year. So it's not like traditionally where they looked at it once and they're not looking at it again. That's the whole point with the 2.0 is they understand risk is changing. And so each year you might see a big impact difference in premium because the type of flooding changed in your area, the distance to water changed. Maybe they drained a river and your flood insurance goes down. You're going to start to see a lot of those factors. But something else you want to take a look at on there as well, if you've looked at the policy and you see what the full risk premium is, that's a good idea too to know what the premium could go to over the next 3 to 5 years. It's not guaranteed, but it's probably a good way to have a conversation with a customer. Hey, when they ask you, hey, what's going to happen in the future? You can't guarantee it, but this is kind of a good guide. Questions? because we got about 20 minutes left in this section. I can go into another part, but usually 2.0 has a lot of questions.
I got one.
Yes, ma'am.
I done a flood policy this week, and they needed $291,000 on the house. So I got the quote for the flood, but at the end it says, do you want private insurance? So will they go above? The quote was $291,000 on their part, so they will go over the 250.
So I'm going to repeat the question so everybody on the recording can hear it. So the question is, basically the quote they wanted was $290,000, but the policy was only going to $250,000. Is that correct? Okay.
The flood quote.
So in this situation, you got that. What happened is the National Flood Insurance Program is only going to the $250,000. What they're offering you is something called excess flood. So excess flood goes on top of that $250,000.
Right, it done that, but
Yes.
the private done the whole amount.
Yes,
It's
private.
like 3 different quotes it gave me.
And we'll talk about that in the last section today about some of the differences. But briefly, yes, coverages are completely different on the private side than they are on the National Flood Insurance Program side. And excess technically is a private policy. But what you're talking about, and I'll talk a little bit about this today because we've experienced this a lot with claims, is you can do a private policy. You could do a National Flood Insurance Program policy with an excess. In our personal experience, though, what we have seen is the claims experience has been better on the private side, because how it works with the National Flood Insurance Program is you got to max out your coverages. When those are maxed out, then your excess policy kicks in. So now you're dealing really with 2 claims, 2 deductibles, and so it can just be a little more time consuming, but in many situations that's the only option you have. Because a lot of private companies, unlike the National Flood Insurance Program, they're going to pick and choose what risk they want. Like for, we'll talk a little bit about this afternoon is, 5-year look back on claims. Some companies, if you've ever had a claim on a property, not even you personally, maybe somebody had one 30 years ago, they still won't touch it. So those are things you want to think about on the private side that we'll talk about this afternoon. But yeah, just as I said, you're going to go to 250. If you get the option for excess and it's there, definitely. What we generally do is we send customers a National Flood Insurance Program quote with excess, and we send them a private. And we explain the difference to them. And then we send them just the NFIP that just goes to 250. And then we send them a recommendation on what we recommend, because we want them to understand all the different options. Because excess can be very confusing.
So if they do the excess, they're going to have, if they do the regular flood quote with the excess, that's 2 policies that they're going to have to pay on.
They are. Now, both of them can be paid through the mortgage company.
Okay.
Yeah. But then the concern you have too is maybe the excess decides to non-renew the next year. Maybe it skyrockets. We're seeing that a lot right now, like in Nashville after last year.
So to me, it seems like the private would be better.
It depends on the risk. And so that's why I was telling people, we'll talk a little bit about that this afternoon on the private side, but what we're going to talk about is like flood history in that area of, hey, is this private going to pull out? What is the risk score? And I don't think I've got in this section this afternoon, but I may a little bit on what's called the 20-year flood zone, is what a lot of private companies look like where they want to insure it. Or, right now, Lloyd's is getting really tight, not just on flood. I think anybody who's dealing in excess right now on any lines will understand that it's rough, isn't it? Our friends in Florida and Louisiana, I don't even know how they're still in business in some situations. And so those things are making things more challenging as well on that excess, because most of that excess is usually through Lloyd's of London or another reinsurer. And so there's a lot of reinsurers are challenging right now on funds and things like that, and it's making excess very difficult. Because I'll tell you, like this week we had to do a $50 million excess policy, and it took us 3 months to do it. Because we had to stack 7 different policies to do it for a building owner. And so it can get very challenging, but you do want to think about that, especially on that replacement cost. Like, let's say that the bank is only requiring $250, or were they requiring $290 in that situation?
Well, they didn't have a mortgage, but
Okay.
I had a question about that too.
So in this situation, let's just say they only offer $250, and let's say the loan's for $450. The bank can only require $250, correct?
Right.
Well, what happens to that difference if there's a total loss?
Right, repeat it again.
So let's say you have $250,000 in coverage, and
Right.
you buy a house for $400K,
Right.
and you have a total loss. What happens to the difference between the $250 and the $400?
See, when I quote a flood, I always put on there replacement cost. So if it goes over the 250, then I do either the excess
Okay, good.
or the private.
Yes. A lot of people don't.
I go by what I come up with on the replacement
Perfect.
cost. I do a replacement cost estimate.
So a lot
I
of,
always put that on there.
yes. And so a lot of property owners, well, the bank's only requiring 250.
Right.
And what happens in that situation, we've actually seen it happen 3 different times, is they only took out the 250, but they had a loan for 400K. They had to take out a disaster loan for the difference. So they were paying almost $200,000 on a disaster loan on a house that didn't even exist anymore.
Right.
And so that's kind of the danger of just doing either what's required or the 250 is and thankfully, something we're seeing in the banking industry is they're actually forcing that a little bit now. Now they're starting to require things above 250, which I'm glad to see. Or let's just say that a property is in a flood zone X, but it's within 20 feet of an AE. We're seeing banks require flood insurance on it now because they're really starting to look at the risk.
So if you have a house that's worth $400,000 and the bank's only requiring $250, if you write and that's all the insured wants,
Yep.
you don't put replacement cost on there.
I still put replacement costs. I put a waiver of this is what we're recommending. In the situation of something that's happening, we just want you to understand that here's additional exposure that's not covered. At that point of just kind of disclosing what the risk is, what could happen.
Right.
Yeah, I don't want to scare people, but also don't. The first thing unfortunately that happens in a situation like that, they come back to you and say, well, why didn't you do that?
Right.
So you really want to make sure they understand the risk.
Can I have one?
You can have many questions as you want. I want this to be as interactive as possible.
It's probably going to sound dumb, but all right. I had another one this week. The same one wanted a quote on the flood, but on their homeowners, you can add inland flood coverage up to $100,000. All right. So he wanted to go ahead and add that onto his homeowners. But he also wanted a flood quote. So I done the flood quote for the $291,000 with the private, and then the dual or excess. So let's say he had a flood claim. All right, would he collect on the inland marine plus the flood?
So probably what would happen is the dual would really need now, did you do the main policy through dual?
On his homeowners, I added that inland flood
Okay.
up to $100,000.
Okay.
It's $50.
Yep.
All right, and then I quoted, but he also wanted a quote on flood. So his house, the replacement was $291,000. So I quoted the flood $291,000, which gave you them 3 quotes. It gave you the $250, the excess, and the private. And the private was the $291,000. I think it was $500.
Yes.
So if he had, let's say he had a claim of $200,000.
Yes, ma'am.
So would he collect on his home and the flood?
So in that situation, really the home is going to be more, the home's going to be more of an excess almost in that situation. Because what's going to happen is the property company is going to come in, the flood company is going to come in, and they're going to look at their policies and say, hey, we've got some duplicate coverage here.
Right.
So end of the day, he's really going to have coverage up to $290,000.
Yeah.
Unless that inland marine was written as like an excess endorsement. It's going to be either or there. And the 290 probably is going to give them better coverage. What we're seeing with a lot of these endorsements is they're only going to do them if they're in a flood zone X or what the low risk is. Or if they cancel their home insurance, now they're losing their flood coverage. If you move them to a different carrier. And so that's some of the challenges with those endorsements. Sure, it would pay out, but usually it's going to be more of an excess if there's another policy out there, just like NFIP. If there was a private policy and an NFIP policy, it depends which policy was set up first.
Okay.
Yeah. It can be very confusing on those situations, especially when you're talking about, hey, which one's going to pay out first? Because we actually had that situation going on in St. Louis that the customer decided to tell us he never canceled his national flood insurance program policy 8 years ago. He's been paying for the whole time.
Right.
So he's got that policy in a private, but the private had a higher amount, so the private would pay out.
Right.
Any other questions? Yes, ma'am.
So I use the private flood market, we don't use the NFIP. They still require an elevation certificate and the flood zone.
Yes.
So is that gonna, do you think that'll change?
So the question is, there's a private company that still requires elevation certificates and the flood zone. And the question is that going to change? We're going to talk a little bit about that later on today in the private side, but that's going to be the difference too, is that what we're going to talk about is, sure, all these changes with NFIP, but how does that impact the private market? What is the private market's response to all these changes by NFIP? And does it so happen to be the same company she was talking about?
It's dual.
Okay, so we're actually a wholesaler for Dual. So we talk with Dual very closely. We're handling $5 million in claims right now with Dual on 8 properties. So we'll talk about not only just, we won't talk about Dual, but what we're talking about is the private company, and we're going to talk about like TPAs. Does anybody know what a TPA is? That's so traditionally on private claims, they don't generally handle them in-house. They handle them with a third-party administrator. And so I think I've got in the private side, we're going to talk about the importance of the third-party administrator, like companies that are changing the claims experience. Like these that we've been working with are an old TPA because the company decided to change TPAs, and it's been a terrible experience just getting responses from the adjuster and all this. But those things play a big role on private. But yeah, so far with them, they have not said anything about those changes, but I know exactly what you're talking about if it's post-firm. And I didn't get into that in 2.0. Probably my fault because I assumed that y'all probably maybe knew. Does everybody know the difference between pre-firm and post-firm?
No.
All right, so pre-firm structure is built before the first flood map, or 1981. Post-firm is after that. So the situation she's talking about is a post-firm property, correct? Yes. So traditionally with the National Flood Insurance Program, elevation certificates were not required on a pre-firm structure because they were grandfathered in. Post-firm, you had to have it. So generally it's 1981 or when the first map came out. Now, in Texas, we have an area where the first map came out in 15 and the house was built in 16. So the house was post-firm. But we have areas that are getting new maps that have never had a flood map still today that could be considered a pre-firm all the way till last year. So that's the difference between pre-firm and post-firm. It's not as big of an issue in 2.0 as it was with legacy, but I mean it was huge. Like you had subsidized rates on pre-firm structures. But I don't think I have anything on our claims, but we have some time, and I'll kind of tell you the difference on this too that we're experiencing in St. Louis with this customer right now. Is pre-firm and post-firm. So you do an addition to a property, or let's just say property substantially damaged by flood. Substantially damaged is 50% of market value or more. It goes from, let's just say that property was built in 1950. It goes to 2022 now with the addition or 50% more market value. So like this customer we're helping, the city's trying to take all his buildings away because they want him to fill the basements in 8 feet with cement, relocate 44 water heaters, 44 furnaces, and he still has to raise the property 3 feet. Now this is where increased cost of compliance comes into play on the National Flood Insurance Program policy, is it pays for up to $30,000 of that, as long as you have it maxed out to $250,000. But that's the big difference between pre-firm and post-firm is when you have these big claims, or you have an investor who decides to go and add a attached garage to a property, or like my office manager who's redoing a house and they added 3,000 square feet and added an addition. When as soon as you do that, it goes from the original year built to the current year when it's being done. So it's important to educate your investors, hey, when you do this, it could have an impact on flood insurance rates. Or you could be getting hit with a compliance issue because you just added the addition. And by adding the addition now, you have to follow different floodplain management guidelines. We have an investor in Arizona right now that's having that problem. He's like, I wish I would have known this. Well, no, he didn't speak to anybody when he started doing additions. And now he can't even sell the property because he can't get a permit because they keep putting liens on it until he raises the house 5 feet. Which is not, I mean, generally, I've never seen a house raised for less than $30,000. So like we just had actually a customer in Nashville that we helped raise it because with legacy, it was low in the premium, $3,200 a year. Had a flood claim, used his increased cost of compliance. We helped him get a grant, he gets done. We submit everything to FEMA and the rate doesn't change in 2.0 because of the way they're looking at mitigation in the new program. But in the old program, it was $2,200. But I mean, if you look at it though, he just raised his house 6 feet. I mean, look at how the risk has changed. So, we got about 10 more minutes. Am I right on that? Okay. Any other questions? I can go into some other stuff as well on this. I just try to leave this section more open for questions with 2.0 because it seems there's been a lot of confusion, a lot of frustration with quoting, what documents are needed, and all this stuff. Yes, ma'am.
Chris, what are some of the big areas of seeing with 2.0?
The big confusion with 2.0, of course, has been the replacement cost that I've seen, is that traditionally someone's writing a building for $250,000, they just throw $250,000 as the replacement cost. Or they're like, well, how's FEMA coming up with this replacement cost? I just wrote a home insurance policy over here, and it's an $80,000 difference. So that's one of the challenges, is that on the residential side, traditionally, it puts the RCE automatically in there. Doesn't mean it's right, but it puts it in there. So there are some ways like appraisal, RCEs, that you can dispute that, because we actually had one that the replacement cost was off 40% with FEMA compared to the property side. Now, we don't do property insurance. Usually what we'll do is go to the agent who wrote it and see if they'll offer us a RCE. And so that's kind of how that works. One of the most confusing parts we've seen on that. The other part is the elevation certificates not being required compared to helping, or being able to backdate the premiums with an elevation certificate. And I just had one we submitted last week that 5 months down the road, and they backdated it all the way to the effective date, and it dropped the rate $1,200.
I had a company a couple months ago, they required, they had the flooding, they already had the flood insurance. I think she had a claim maybe last year, wasn't a real big claim. But then they come back and require an elevation certificate. And so the insurer said it was okay for them to go ahead and do it. So they sent someone out and done it. I think she had to pay like $500 or $600.
That sounds about right, North Carolina. In New York, that's a $2,500 job. Yeah. Now, what we'll talk about, because you brought that up, and I think I forgot to mention here, is the claims variable. So what happens with claims variable now in 2.0, this is something that is really challenging. Probably haven't run into it yet, because you may have not experienced any claims 2.0. Unfortunately, we experienced them 2 weeks after 2.0, because that's when the disaster in Birmingham happened. So claims variable looks at, let's say you go to file a flood claim today, and you filed one 10 years ago as well. Maybe not you, maybe the property owner. So now FEMA goes back and looks at the claims variable, and they say, hey, we've got 2 losses in the last 20 years. We're using that as a multiplying factor on the renewal rate. So your rate may skyrocket because of that claim. So it's important to help people understand, hey, if you've had claims filed on this property, not necessarily you, within the last 20 years, they do a 20-year rolling look back now. So it's important to understand, what's called the claim variable of the impact we could have. Because what we see is a lot of people filing $1,000, $1,200 claims like you do on a property. But what they don't realize is these claims stay on a property forever. So if they ever want to go to the private market, they may not be able to, depending on the carrier. And so that's why, when we meet with someone about a claim, what we're explaining to them, hey, here are the short-term impacts. Here are the long-term impacts. Like we had that happen with that customer in Birmingham a day after he bought it. And he's like, I got my non-renewal. He said, I'm not mad, though, because you explained the process to me. And so FEMA's not going to non-renew it because of that, but it doesn't fall between that 18% statutory rate increase because of claim variable. So you may have an $800 rate go to $2,000. So it's important to understand how claim variable plays an impact with 2.0. Did you have a question? I thought in the corner of my eye, I saw you raise your hand. So just kind of re-highlight 2.0, things to look for, as I said, that claim variable, replacement costs that are big impacts, flood zones no longer determined rates, elevation, FEMA's using its own data to put elevation in, or you can go get an elevation certificate, and you could really look at the two difference, or you can find an elevation certificate. So those are the big things with 2.0. Coverages aren't changing, wait periods aren't changing, but those are the big things. Diagrams are changing with elevation certificates. So that's really just a highlight of 2.0. And then on the next section, when we get back from break, we're going to be talking about, I believe, flood maps. Has anybody ever done a flood zone change? So we're going to show you how to do a flood zone change. We're going to show you where to find revalidations, amendments, and things like that on that map as well. So that's what we'll be covering in hour 2, is those 2 things. And then hour 3, we'll be talking about private flood insurance, with NFIP, and kind of all the different things you need to know, because it's not just one system of private. Every carrier treats everything different. We got about a minute left. Do we have any final questions? If you do, we can also answer them in hour 2, because a lot of the stuff in hour 2 probably is going to bring up stuff in hour 1, so you may have more questions. So if you do, raise your hand at any time. I want this to be as interactive as possible to make sure that you kind of understand not just 2.0, private, map change, all this stuff, especially in North Carolina. The last section, we're also going to talk about some local impacts with 2.0 with all their changes.